Welcome to the Big Money Show. I'm Brian Bremberg, along with my co-hosts Taylor Riggs, Jerry Willis, Jackie DeAngelis, and with us for the hour, Barron's Investor Circle newsletter editor Josh Schaefer. Welcome to you, sir.
Yeah, good to be back.
Well, chip stocks have been powering the rally. AMD soared after blowout earnings, sending the NASDAQ to new highs. The Dow hit 50,000 this morning. It's just shy of that now. And adding to the momentum, Iran and the U.S. are reportedly working through mediators on a one-page framework to restart full nuclear talks in Islamabad as soon as next week. President Trump says he's optimistic.
We're in good shape. And now we're doing well. Now we have to get what we have to get. If we don't do that, we'll have to go a big step further. But with that being said, they want to make a deal. We've had very good talks over the last 24 hours, and it's very possible that we'll make a deal.
Okay, Mr. Schaefer, how dependent is this rally we're seeing on this particular version of the Iran deal getting done?
I don't know how dependent it is. I think the market itself right now is dependent on AI, and so it seems like from where I sit and thinking about kind of the stock market aspect of this, it all is sort of AI oriented right now. When you look at what's been driving the market higher, it's really all chip stocks. It's all companies that are in the AI build out, whether it be energy pieces, et cetera. So I think maybe it could shake markets a little bit. Yes. But to be honest, Brian, we've been through this several times over the last couple of weeks, and it hasn't really shaken investor confidence at all. So I'm not too sure why this time around it really would shake investor confidence again.
Okay. So Taylor, if it's not as dependent on Iran.
Nope.
And it's more dependent on what Josh is saying, then are the underlying fundamentals supportive of the kind of rally we're seeing here?
Totally. And it's controversial because people don't like high gas prices, but the fundamentals of the economy that we see are strong. Let me hit you with 3 data points. I have a lot to say. I know I'll try to be fast. Number one, earnings. Earnings just accelerated from the fourth quarter of 13% growth to 27% year-over-year growth in the first quarter. That is what we are seeing, pretty much a 4-year high and an acceleration that is rarely seen outside of major shocks. AI is clearly a contributor, but the double-digit growth in the bottom line is happening in average and median companies, not just AI, with all due respect, though I hear you. And all 11 sectors have posted growth for the first time in 4 years. So, yes, it's AI, but there's also something else going on. RXO, it's a shipping company. They just came out and said this is like the beginning of the cycle. What do you mean? Like, we've been in a business cycle since 2019. He said we are seeing, my words, green shoots, not his, but the beginning of a huge cycle. That was point 2. Point 3, did you guys see the productivity numbers that came out this morning? Shocking.
Yes.
Because yes, it is AI, but it is working its way through the economy. And Brian, I know you didn't see them. You're just saying that you did.
What are you talking about?
You did see them?
What? Sort of.
Let's talk about it. Okay. Labor productivity is at like a 2.1% annualized rate. The last 20 years, the number has been 1.5%. We are hugely more productive in the last couple years, in part thanks to AI, than we have been in previous business cycles. As this quarter was up 2.9%, the average in the last 25 years is 1.5% to 2%. So point 3 is productivity is booming. What does that mean for inflation? That's good news because the unit labor costs are falling. So it's costing me less as a business to run things because the unit labor cost is down, productivity is up. That's why earnings are up. And that's why you get companies that, despite the Iran war, are saying this is still almost full steam ahead.
So, Jackie, I don't know if I buy what Josh and Taylor are saying about this being independent of Iran. I think a lot of this has to do with the effect on oil prices, the hopes that we're beyond this, and what do you think?
I think it's 3 things. I think oil coming down to 92 right now, and the hopes that a deal will be on the table. And I mentioned this yesterday, that word that Marco Rubio used, end end to the project because we have achieved our objectives has been very significant in boosting confidence. That doesn't mean that what Taylor and Josh are talking about and the underlying fundamentals don't have to be good to allow this rally to move forward, but they want that risk taken off the table. The oil matters for so many aspects, but the way I see it, you want lower gas prices. That'll keep the consumer stronger, but you want lower gas prices and oil prices for inflation, and that could potentially create a situation, depending how quickly it happens, where all of a sudden you might have a Fed that might be more interested in cutting rates. Right now, the view is that rates are not going down anytime soon. But if all of this were to turn around pretty quickly, you really never know what could happen. And we know what the prospect of lower interest rates does to this market. On the earnings front, we've been talking about AI investment, how it was scary at the beginning of the year, but now all of a sudden investors are okay with it. They think that the runway has been set for that investment to start paying off. And I think that that's positive with respect to the tech and the chip stocks. And then, on the productivity side that Taylor mentioned, I would just say between the AI, between the manufacturing that's coming back here to the United States and the aspects of the big, beautiful bill that are reaching people's pockets, if this duration of the war is short and oil prices do go down and gas prices don't kill them and spend all their rebate, all of a sudden you've got a pretty good second half of the year shaping up right here. Oh, and we solved the crisis in the Middle East and created peace. Wow. Okay.
Jerry, who has many notes on this subject, which I cannot wait to hear all of. I do want to ask you, look at this, it's unbelievable. Now, this is only a 2-hour show, so just keep that in mind.
Well, let me get started.
Okay, so go. But are we buying on a lot of hope right now in the market? Is that what's going on here?
Well, the Axios story was responsible for what happened in the market starting yesterday afternoon, right? We had a huge gain. Everything flew higher, right? Well, the Axios story is still rumor. There's not a deal.
The deal points.
They had deal points, but they're not. Everything is not worked out. We're a long way from that. We've got a long way to go. So the old saying on Wall Street, I worked on New York Stock Exchange floor for 3 years. Buy on the rumor, sell on the news. Once the actual deal is done, then we're going to have a sell-off. You need to think about what you might lighten up on. I'm not saying the market's all going to go down, but you might want to do some serious thinking about trimming. But my real point here is that earnings is a huge thing, and earnings isn't just a story about AI and feeding the AI beast. When you dig into these numbers using Sam Stovall's numbers, you see that across the board, S&P 500 earnings estimates have been rising dramatically from March 31st, where the growth was expected to be in the first quarter, 13.3%. It's gone to 24.5%. 2026 has gone from 16.4% to 21.2%. And it's not just tech and energy, which have been the big gainers here. Healthcare companies have been beating 88% of healthcare companies beating estimates in this quarter. Consumer staples, how boring is that?
Very.
86%.
Ooh.
Communication services, 78%. Financials, 82%. Industrials, 80%. So what you're seeing is kind of an across-the-board growth, and I love to see that. I think that's great news. That means you can pick your hits as we get into the second half of the year if you don't want to stick with energy, if that's played out by that time.
Well, something we've been talking about, too, in terms of why earnings are growing in other areas is who is a Capex grower or Capex giver versus a Capex taker. So if you go back to big tech earnings, you have that combination of hyperscalers spending almost $1 trillion this year. Some Wall Street analysts will tell you that number will get up to $1 trillion in 2027. Then you look at what stocks have been working over the last couple of weeks. One company's spending has to be someone else's revenue. And so that builds beyond just chips. That's obviously why chip stocks are rallying. People can't get enough chips. They're trying to buy more. They're buying chips that they didn't think were good 2 years ago. Now they're good enough. That's great. But companies like a Sterling Infrastructure is a stock we had highlighted at the Barron's Investor Circle. What they do is they build data centers. And they were on their earnings call earlier this week. The stock went up 50% in a single day because they were on their earnings call talking about these hyperscalers who say, build me more data centers, go into new states, build these up, build these up. And so the demand also isn't just chips, it's not just technology, it's who's fueling it, and that's how you get really a broad impact from AI that I do think percolates the most of the market.
Political piece to this, and I know we're really, far out ahead of the midterms, but again, I go back to the conflict in the Middle East, the war. If all of a sudden we have a peaceful resolution faster than everybody was assuming, faster than the market was assuming, perhaps, depends what side of the fence you are with respect to midterms, whether Trump, and the Republicans ever had a chance of winning them. But if you think that they do and they could defy gravity and history, then peaceful resolution, strong economy, all of a sudden the midterms might start being priced into this market too.
Very interesting. And what did you say about consumer staples?
They're beating industry or Wall Street estimates handily in the 80th percentile.
So that Jackie, what you said, you kind of put in the political element into this with consumer staples. Taylor, you've been on like the stressed consumer, or at least the gas prices on consumer thing. But it seems like day in, day out, week in, week out, the data in terms of spending, earnings, projection is telling us something different there.
Yes, the only caveat to that, and I know you roll your eyes when I talk about consumer sentiment surveys or expectations, but the New York Fed came out with their inflation expectation survey, and consumers I would have projected that the 1 year ahead inflation expectation is up 3.6%. Now, what I say doesn't matter as long as what I do is different. But inflation is a little bit different, and you know this. If I feel like prices are going to go up, eventually if that becomes entrenched and changes behavior, then it becomes a self-fulfilling prophecy and prices go up. So I only watch consumer sentiment and inflation expectations to make sure that that entrenched data doesn't then change behavior. And right now consumers are telling us they are really ticked.
I hear you on that, and I think it's true. But sentiment does change all of a sudden when the market is doing well. We talk about how so many more people have access to the market. Well, if you're looking at your 401k and you're at an all-time high, but gas is at what, $4.55 now is the national average, you might feel a little bit better about what you're spending at the pump when you're seeing that your stock earnings or your future earnings are doing much better than they were. Because when you think about what happened during the war, we all lost a chunk of money, but we got that back. And generally, if you're sort of broadly invested, now you've reaped rewards even past that. And so I think that balances this out a little bit, but it's a very, very tightrope.
Yeah, that's very interesting. Here, a good example of what we're talking about here is Whirlpool, Taylor. Okay, so they're out with earnings and guidance and a reflection on the consumer. What are they saying?
Not good. Okay, shares are down 13%. They said that demand for appliances feels like we're in a recession. They said it hasn't been this bad since 2008. So if that's not a sign that tells you how things are going, that could be it. Now, they said they factored in record low consumer sentiment, the economic impact from the Iran war, and severe weather. All of that drove a 7.4% contraction in industry demand during the first quarter. Again, that's just what the CEO is saying.
That's what they're saying?
Yeah, I don't know.
All right,
about
weigh
that.
in. Let's go.
Your washer dryer Whirlpool appliance is probably the last thing that you're going to replace if it at least is still alive and kicking and working. I just feel like people shift their priorities, and this could be more company specific than necessarily overall spending specific.
And could it
The stock
be
is
housing?
down.
Could it be housing specific? I mean, the housing market's still in the toilet, and that's when people buy washers and dryers. They're talking about, people who are trading up in their home, that's okay, but people who are buying for the first time, that's a problem for them.
Stock's down 80% over the last 5 years.
Wow.
So they're having some specific issues, I think, with their own business and not necessarily the consumer. When CEOs start talking about the macro headwinds and not everyone else is talking about them, you start to wonder whether it's a company issue or really a
Macro headwinds does sound like kind of a convenient excuse when you're just struggling.
Yes.
But I could also see big ticket items being something where if budgets are getting tight, you don't replace
And there's
thing.
a lot of competition in that marketplace too. So consumers have a lot of different options. I recently got a washer dryer. I did not get a Whirlpool. It wasn't even on my list. So this one sounds a little fishy to me.
Jackie did not buy a Whirlpool. It hurt us last quarter. All right.